Hi dear traders! Last week ended with news that raised market expectations for more aggressive steps from the Fed. Thus, inflation slowed down slightly and the data on retail sales confirmed that the stability in the US economy and its readiness to withstand another increase in interest rates. But for investors in the stock market, this is not good at all. At the end of the last trading week, US stock indices lost an average of 5%, which is quite impressive. Against this backdrop, the US dollar strengthened to a 20-year high near the level of 109.80. As a result, it closed the week with an increase of 0.87%. As inflation slowed down, markets' expectations grew that the Fed could raise interest rates straight by 100 basis points instead of 75 this week. In addition, demand for the US dollar has increased due to its status as a safe haven asset, especially now when the global recession is looming amid renewed lockdown measures in China and the approaching energy crisis in Europe. Thus, the single European currency returned to the parity level against the US dollar, yet is still holding afloat thanks to a more hawkish stance of the European Central Bank. Eurozone monetary authorities reaffirmed the need to raise the rate without waiting for the slowdown in the European economy and a drop in inflation. For your reference, at its last meeting, the ECB raised the rate by 75 basis points, and it's quite obvious that a similar decision will be made at the end of the next meeting. Meanwhile, the British pound tested the 37-year low last week, falling to the level of 1.1362. This drop happened even despite the intention of the Bank of England to hike the rate this Thursday. The investment attractiveness of the pound is low as traders are focused on the threat of an impending recession. In contrast to the United States, retail sales in the UK continue to decline, while inflation is running at its peak levels. Similar situation is with the Japanese currency, which is losing its ground against the US dollar despite holding the status of a safe haven asset with stronger protective properties. The Bank of Japan is not going to raise rates and maintains its dovish stance, which is the reason why the yen has weakened so much. The yen is trading at its lowest level of the past 24 years. The country's government makes verbal interventions, but they are all in vain. They are now considering the possibility of foreign exchange interventions. Yet doubts about the effectiveness of a one-time buyback of the yen keep the pessimistic mood in the market. The traditional safe haven asset gold is also in low demand among investors. The precious metal closed last week below the key level of $1,680, which increases the pressure on the trading instrument. Meanwhile, the World Bank and the International Monetary Fund cut their growth forecasts for the global economy, and major US companies issued weak forecasts due to the bleak economic outlook. Of course, in such conditions, the price of gold should rise. Yet, amid a sharp increase in interest rates by key central banks, investors prefer to transfer their funds from gold to alternative trading instruments such as government bonds. In the meantime, the oil market stays stable. Since oil is denominated in dollars, a strong US dollar has increased the downward pressure on oil prices. But beyond that, oil has plenty of reason to fall, especially amid threats of global recession. So last week, BRENT crude remained slightly above the level of $90 per barrel. These are the trends of the last trading week. Don't miss also our traditional weekly review, which is due tomorrow. And of course, follow our daily news reports to be always in touch with the latest events. See you soon.